Hey everyone, if you're getting ready for the SAFE MLO exam, you know some topics are just non-negotiable. You have to nail them. And right at the top of that list, the ability to repay and qualified mortgage rules. These aren't just tricky exam questions, they are, quite literally, the foundation of modern ethical lending. So let's crack this code and break down exactly what you need to know to walk into that test with confidence. All right, here's our game plan. We're going to start with the why, the story of the financial crisis that created these rules in the first place. Then we'll dive right into the heart of the ability to repay rule. After that, we'll talk about qualified mortgages, which is the lender's answer to the ATR rule. We'll compare the two main types, general and seasoned QMs, and then we'll wrap up with the very specific rules on prepayment penalties. You'll see, it all fits together like a puzzle. So first up, let's set the stage. Why do we even have these rules? To really get a handle on ATR and QM, we have to rewind the clock and understand the massive problem they were designed to fix. This right here, this is the central question. The 2008 financial crisis completely upended the world of mortgage lending. It pulled back the curtain on some really risky practices where loans were being handed out left and right to borrowers who, frankly, had no realistic way to pay them back. This led to a catastrophic wave of foreclosures that sent shockwaves through the entire global economy. And what followed was a direct legislative response. In 2010, you had the Dodd-Frank Act. This massive piece of legislation created the Consumer Financial Protection Bureau, or the CFPB. The CFPB's job was simple: write new rules to make sure a crisis like that never happened again. And by 2014, their work gave us the ability to repay and qualified mortgage rules, creating a whole new standard for protecting consumers. And that brings us right to Section 2. The ability to repay rule. This is it. This is the bedrock principle, the core idea that came directly out of that crisis. The real power of this rule is how straightforward it is. It's not a suggestion, it's not a best practice, it's an absolute mandate. Lenders have to do their homework. They have to prove that they believe in good faith that the borrower can actually handle the loan payments. For your exam, think of this as the #1 golden rule of modern lending. Get it wrong, and a lender faces huge legal trouble. Now, just as critical for the exam is knowing what the ATR rule doesn't cover. Test writers love to quiz you on the exceptions, so remember, this rule doesn't apply to open-end credit like HELOCs, it doesn't apply to reverse mortgages, and it doesn't apply to super short-term loans like bridge loans under 12 months. Make sure you've got this list of exemptions down cold. So how does a lender actually prove they've made that reasonable good faith determination? Well, they have to follow this 8-point inspection. Think of it as the mandatory ATR checklist. They have to look at income, employment, the new mortgage payment, any other loans, taxes, insurance, the whole shebang. And here's the kicker. They have to verify all of it using reliable third-party records. This list is absolute gold for your studying. You need to know these 8 factors inside and out. Okay, moving on to Section 3. So if every lender has to follow that 8-point rule, how can they be, certain they're compliant? How do they protect themselves? Well, that's where the idea of a qualified mortgage comes into play. You should think of it as a safe harbor for lenders. And this right here is the key connection, the light bulb moment. If a lender makes a loan that fits the very specific definition of a qualified mortgage, or QM, they get a legal presumption of compliance with the ATR rule. It's basically a standardized recipe for a safe, affordable loan. It gives lenders a clear, predictable way to follow the law. So what makes a loan a QM? It's really defined by the risky stuff it doesn't have. A QM can't have negative amortization, where your loan balance actually grows. It can't have risky interest-only payments or a big balloon payment at the end. The loan term can't be longer than 30 years, and this is a big one. The points and fees are capped, usually at 3% of the loan amount. These are the bright line rules you'll definitely see on the exam. All right, let's dive a little deeper now in Section 4. The rules actually provide 2 main ways a loan can get that valuable QM status. We're talking about general QMs versus seasoned QMs, and you absolutely need to know the difference. This chart lays it out perfectly. On one side, you've got the general QM. It gets its status right at the closing table, from day one. And its qualification is mostly based on its price. Its APR can't be too high compared to the market average. On the other side, you've got the seasoned QM. This loan earns its status over time by proving it's a good loan through the borrower's solid payment history. It's the difference between being qualified from the start versus proving your worth over time. For general QMs, it really boils down to the price of the loan. The APR can't be too much higher than something called the average prime offer rate, or APOR. The basic idea is that a super high-priced loan is probably a riskier loan. And as you can see on the table, the rules give a little more wiggle room for smaller loan amounts. These are the exact numbers you'll want to have memorized for the test. So what about the seasoned QM? Well, this whole concept is kind of like a second chance for a loan. Let's say a loan didn't quite meet that pricing test to be a general QM at closing. It can still become a QM later on, but only if the borrower proves they can handle it by making their payments on time. It basically proves after the fact that, yep, this was a safe and affordable loan all along. And the magic number you need to remember here is 36. 36 months. That's 3 full years. The clock on this seasoning period starts ticking from the due date of the very first payment. For those 3 years, that loan is under the microscope, and its performance determines whether it gets that coveted QM status. And here's the test. This is what a loan has to do to pass. Over that 3-year period, the borrower can't have more than 2 payments that are 30 days late. And, this is the big one, they can have absolutely 0 payments that are 60 or more days late. The standard is tough for sure, but if the loan meets it, it earns that QM safe harbor status for the lender. All right, that brings us to our final section, and it's a really important one, prepayment penalty rules. These are the specific, strict limits on whether a lender can charge a borrower a fee for paying off their loan early. Okay, if you write down one thing from this section, make it this. Prepayment penalties are almost entirely banned. They are only allowed on a fixed-rate, qualified mortgage. That's it. If the loan has an adjustable rate, or if it's not a QM at all, a prepayment penalty is illegal. Period. End of story. And even on those few loans that can have a prepayment penalty, the fees are capped and they phase out really quickly. In the first 2 years of the loan, the penalty can't be more than 2% of the balance being paid off. In the 3rd year, that drops to just 1%. And once you're past year 3, no prepayment penalty can be charged at all. It's gone for good. So, there you have it. We've gone through the mechanics of the ATR and QM rules, all the stuff you need to know for the exam. But the real point is bigger than just passing a test. These rules, at their core, are about responsibility. They're the framework designed to make sure that we, as loan originators, put every single borrower into a home loan that is sustainable and that they can genuinely afford. Understanding this isn't just about getting licensed, it's about being a great, ethical MLO.